Can everybody hear me, or is it cutting out again? How's the video? Good so far, yeah. I was gonna make a main line and run it right into my computer, but I ran out of time at work. We had all the cable and we had all the heads, but I couldn't get it done in time. So, if you guys can hear me and you can see me all right, or well, not see me, but you can see the screen all right, then I guess we can go ahead. Give me a bunch of thumbs ups, and I'll start into it. I'm getting kind of decent colors so far on my stream feed. Awesome. So yeah, just let me get started, a little organized here on my windows on the other side, and that way I can see your chats as you guys kind of bring them up, and we can go from there, and hopefully we can all learn something today. I'm here. Of course, Judge has got to come in. I thought you were going to miss this one, Judge. I was hoping you were going to stay out of this, but it's all good. You guys can tear me apart, and if I don't know the answer, I'll be honest, and I'll let you know, and together we can find it out and share it with each other. Going forward. Gina, I believe Jordan will help you out with the link. Okay, guys, so TCG Flightschool. Me and Jordan just started this recently in collaboration with the chart guys. Obviously, I was kind of taking the lead and posting charts and learning technical analysis and posting it in our marijuana stock traders group, which has been great. I've been learning from it. I know some other people have been learning from it. Yeah, Pat, it's just the cover page for now, and then I'm going to get into some charts and stuff in a second. So, sorry you're not going to see my beautiful face today, but maybe one day I'll reveal myself to you. Anyway, so yeah, we started getting into technical analysis. I made some mistakes in the past. I just jumped into the marijuana sector in November, in that giant bull run in November that we all remember. And I had some wins and I had some losses, and I really wanted to figure out how you could capture this moment, how you could take advantage of it and capitalize on it, and not just get caught up in the bull run and buying and selling with market buys, which I was doing for a while. I know Gina is guilty of that as well, because she confessed to me one day that all she knows how to do is market buys. So put you on the spot there for a second, but yeah, I was buying and selling on market. I didn't even know what a limit order was, and this is not that long ago. This is in October, so I feel that I've come a long way just from that, and I just want to keep sharing this information as I'm going with all of you. So a little background on myself. I'm not schooled. I didn't go to university. I started working when I was young. Dropped out of high school, got back into it, and then worked in trades, worked in the oil rigs, dabbled with a little bit of penny stocks in 2012. Had some ups and downs, and but I've always really enjoyed patterns and math and stuff like that. So as soon as I kind of learned about technical analysis in trading, and that was what I started to apply myself with. I've never been a big gambler. All my friends love playing poker. They love going to the casinos and stuff like that. I feel I have no control over my money when I'm gambling. You're just putting on red or black, and you're buying on hope and waiting for luck, essentially. And that's what technical analysis is trying to take out of the market, is not to buy on hope and hope for luck. It's an idea to better yourself, to study, to be educated, to find safer entry and exit points where you can use and apply risk management. And hopefully capitalize on some gains. I mean, that's the whole point, right? Is we're all here to make some money. We're not here to give our money back to the market. You might have to pay a little bit of market tuition on the way up, of course, because that's just part of the game. And you have to be able to accept loss. That is, being able to accept loss is being able to control your emotions. And if you can get past that, then you will move forward. Yeah, Gene, I'm just leaving this up for a second for the introduction, and then I'm gonna move forward after that, and you'll see some charts and some pictures, and some no more gifts. We're no gifts today. We'll save the gifts for tomorrow. And yeah, so through that, me and Jordan met through the Marijuana Stock Traders, and we both seem to take a liking to technical analysis and learning from it, and watching a lot of you guys, not to point fingers, but a lot of people and ourselves make mistakes in our trades, and why are we making those mistakes? So Lutz is similar to me. We're both young families. We both work long, hard jobs, but we want to be better for our families and provide a better life financially and free up some more time. So the end goal is to go down to part-time work or even no work and become a full-time trader. I mean, Brian's a perfect example of that. The guy left his job a couple of years ago. I really idolize him and look up to him for that. And he's making it work with his family. And we're talking about real estate moves and stuff that he's doing as well. And I love that. And to hear those types of success stories just drives me harder to learn and study and apply myself more. So that being said, this is where we're at. We're starting a flight school, essentially ground up, learning the basics. We can all learn together. We've got the support of the chart guys behind us. They've taken under their wings for a mentorship program, and through that we'd like to share some of this information and knowledge with you guys and keep moving forward. So today is just going to be some basic stuff. We're going to go through some candlesticks. We're going to go through some time frames, right? So looking at the anatomy of the candlestick and their significance to price action and patterns, looking at different time frames to look at these candlesticks on, because there's a 1 minute, 5 minute, 3 minute, 15 minute, 30 minute, 1 hour. All these time frames have a significance in technical analysis, a major one. So we're going to look at volume, bullish and bearish volume, confirmation of the breakout and breakdown and what to look for. We're going to look at some moving averages. We're going to look at MACD. That's not in here, but I threw it in as well. So the moving average convergence to divergence, and then we're also going to look at RSI, which is the relative strength index, and we're going to look at kind of how I set up my charts and how Jordan sets up his charts, and go from there. So I will close this down here, pop up my chart. So obviously this is my baby. This is EMH. This is I've been following this here since the PP bought deal here on February the 1st when we gapped down, and I think this is when I started comparing it towards Aurora, if everybody remembers. We started comparing it here and watching to see if it was following the same chart pattern. It did follow for a while. Some of us got in here in the low 130s, and then I think I jumped out here in the I get back in the 130s, and then some people made some moves up here in the high 140s, and then we saw a continuous downtrend and up into this bull run into April, and then we've seen a very steep decline and downtrend here into this wonderful, beautiful green candle that we all experience today. And I hope you just want to be, before I go any further, is to just say, I hope you guys made some money today, and I hope that any charts or anything that I've thrown up along the way has brought us to this point that we kind of capitalize on this moment that we all experience today. So I'm just going to, Gina, is it cutting out at all? Cut off in the middle? Is everybody else getting good volume and good screen? You might have to yell at me if through Facebook chat if you're having some issues. Working good here. All right, Mike, so I'm going to keep going. So, all right, guys, we're going to talk about just candlesticks, because obviously candlesticks form the basis of technical analysis. So we have a bullish candlestick and a bearish candlestick. The biggest significance between the two is that a bullish candlestick opens at the bottom. Just let me turn my volume down here in case you guys are getting some feedback. A bullish candlestick opens at the bottom and closes at the top. A bearish candlestick opens at the top and closes at the bottom. And that you can see right here in this. We'll just look at the April run-up on EMH. You can see that we opened up down here at a low of 130, and we pushed all the way up to a high on this day of looks like 148, I believe, right? And then we closed. We had no wicks on this candle. We opened at the low and we closed at the high. So the wicks represent a low and high. So essentially, these can make up all sorts of different formations. If we go over to the November side, look, we see a very long wick. That means that this candle opened up, it sold or fell down a little bit to create a lower wick. It ended up pushing all the way up to a high of $1.89, and then it ended up selling off before it finally closed down here to form the top of the body. On the bearish side, same thing. So we'll look at a bearish candlestick with a long wick over here. We opened up at the top of this candle. We pushed up to a high. We could not sustain it. We sold off down here to a bottom of 159, and we ended up buying back. The bulls bought the dip back up, where we found a close at the low of the body of the candlestick. So difference between a bullish and bearish candlestick. And you know, that is the story. That's the story of price action. Every single body and every single wick tells a story of price action from the start of the time frame, from the start of the candle to the end of the candle. So whatever time frame you're looking at on, if you're looking at a 1 minute, a 3 minute, a 5 minute, that candle represents that time frame, that moment in time where price action was created through an exchange, through us buying and selling shares, right? Because that's what it is. It's an exchange. Someone has to buy, someone has to sell shares in order for you to buy, and someone has to buy shares in order for you to sell. So essentially, we're all kind of working against each other, but together, you know, we can be united and find the same entries and exits and work on, you know, making profits. Everybody has a different trading plan. Everybody has a different investment horizon. I've said that numerous times. You guys have heard me, you know, rant on these rebuttals of philosophy of, you know, stick to your trading plan, stick to your investment horizon. Don't be confused. Don't have FOMO. Don't have potential profit miss outs. Don't compare your account to somebody else's account. All of these things I've said over and over again. And, you know, these are things that I've learned through the years, things that I've learned recently. It's never good to just compare yourself. You need to focus on you. You need to better yourself as much as you can. Sorry guys, Boris didn't pay the bill this month. Hey, there's no cats in here. Easy. Big close, strong close today though on MMJ. But I'll keep those comments to myself. Anyways, going forward, of course, yeah, so that represents the two candles. So, and in those candles is how we're going to create price action. So, just going to talk a little bit about the different types of candlesticks that can be made, and also that, you know, out of the 4 points of the candle in making it up, the close is the most important part of the candle, in my opinion, and many others. The close represents, you know, where that price action left off, and creates the formation and body and you know, total complete package of the candle, and how it is used in technical analysis in finding patterns and moving forward in trying to predict what is going to happen. Because you know, technical analysis is based off of previous price action, and it is our best chance at predicting future price action. It will not tell you what is going to happen, but it gives you the best possible opportunity based off of just emotions in the market and, you know, the way the market is traded for since the beginning of time. So, well, not the beginning of time, but obviously since its inception. I mean, and I don't even know what years the market started. I can admit that. I'm sure that many people don't know when trading started and stock exchange opened, because we just haven't looked into that history, or maybe you do, but you know, it goes back a long way, and it's plotted the whole time. And, you know, some trends like SPY and TSX Composite, you can follow those trends from, you know, the last 10, 15, 20, 30 years, however long it's been going on, and you can start to see these patterns. These things are not made up overnight. Just because marijuana sector is a new sector doesn't mean that, you know, technical analysis cannot be applied to it. People still buy and sell the same, and you have institutional buyers and sellers, market makers, and retail buyers and sellers. So that being said about candlesticks, I'm just going to get into kind of the other formations of candlesticks that you can see. So there's a whole ton of candlesticks that can be formed, right? And each one has a significance, but not necessarily on their own. A candlestick needs multiple conformations to kind of give a significance or hold weight and bearing in the full picture of technical analysis. One hammer candle just placed anywhere doesn't necessarily mean a reversal. This is technically a reversal candlestick, usually at the bottom of a downtrend, where you will see what has happened is the candle opens, right, and the the bears sold off. The bears took control, and we had a sell-off, and then the bulls bought up and pushed this candle up to close at the high of the candle, right? So it's closed at the high of the time frame. Let's just, you know, talk about daily time frame. So, you know, if you saw one of these and we pushed up close to the high, there is a possibility or good chance we could see a continuation into tomorrow, you know, a possible gap up because we closed at the high of the day. Similar to today, we closed at the high of a day on a lot of MJ stocks, and if you ask any technical analysis person, they will tell you that, you know, there's a good anticipation that there's a possible gap up tomorrow. Obviously, anything can happen, and you can't bet the house on it. Well, you can if you want to, but the idea is that it gives you the best idea and representation of what is going to happen in the preceding days. So we have some dragonfly dojis, gravestone dojis, long-legged dojis, short dojis. These are obviously bearish candlesticks on the dark side, and these are bullish candlesticks on the white side. Spinning top, spinning top. So I still myself are trying to learn and remember what every single one of these do. Marbozus, right? So we saw Marbozu actually here. So there's a Marbozu candlestick. Opened at the low, closed at the high. Its significance on its own, well, if the next day it pulls right back, not necessarily anything, but open at the low, close at the high. That was a bulls in control all day long. And look, we saw a huge gap. Well, not huge gap, but 154. Looks like we saw about a 5-cent gap up, right? Almost a Marbozu, just a white candlestick on this one, and a gap up into the big push where we couldn't break the high, and then the bears took over and we sold off. So again, I will leave those two up for a second here, and I'm going to pull up one more. So I'm not watching the chat so much right now. That's why Jordan is backing up in the chat with answering some questions. I'm going to kind of do a Q&A thing right at the end where I will actually just focus on the chat, and we'll pull up some charts, and you guys can ask me some questions about some charts, or if you want me to go back and look at something, we can go back and review it really quickly. But yeah, forgive me, and I apologize if I'm not just paying attention to the chat right through. I kind of have a little bit of a lesson plan set up, so I just kind of want to keep on progression with that, and then, you know, we'll do a little bit of Q&A at the back. So at the back end. This is the candlestick kind of cheat sheet that I found online. This is great, actually. I grabbed this a long time ago, and this has really helped to just, you know, kind of show me the significance. Actually, here, just let me pull up. So here's the candlestick formations, and you can start to see where these play significance in these kind of formations, right? So here's the hammer candlestick I was telling you about. So here's your downtrend, and there's your hammer bullish bullish reversal hammer candle, showing an uptrend after that. Inverted on the other side, right? So we saw a bearish inverted hammer candle at the bottom of the downtrend, can also signal an uptrend as well. So again, you have to look at these, you have to find them on the charts and see where you know, they hold weight and hold significance. So right here, I can find bearish hammer reversal candle. So it wasn't a huge downtrend, but we sold off here. We came down, we found a little bit of support here, and some bulls bought it for the day, but then we continued our downtrend, and then we sold off again, probably in the morning, knowing EMH, and then the bulls bought it back up to close at the high of the day, where we moved into Dragonfly Doji. The Dragonfly Doji is usually held at the bottom of a downtrend, as you can see here. So this significance on this candle, not so much, you know, but the fact that it did have a dip and then came up, pushed to a high and sold off, and we continued on an uptrend. Nothing is perfect, nothing is absolute, but the idea is if you can find all of these and you start to see them forming, it can help you to anticipate and, you know, jump in on a trade with a set risk versus reward, which we'll talk about probably in the next seminar, is risk management, and, you know, where to place a stop loss and stuff like that, and it'll give you the best idea of where to move forward and picking your trades and going from there. So I mean, EMH, like I said, I've been watching for weeks now. I've been watching all the way through this downtrend and these big dips, right? And so when I saw this downtrend and this big dip here, and this steep kind of waterfall action coming off here, a lot of these candles have no weight or no significance. The only thing that shows me is they had little dips on the way down, but they really did nothing except for open at the high of day and sell off, right? They opened at the high of day, sold off. Open at the high of day, open at the high of day, open at the high of day, 3 in a row, sold off, little bit of bull buying at the bottom end, and then a close. We have a spinning top here. and then we came down, and I can't see that one because the low is in the way, but you get the idea. Same with here, we have a spinning top, kind of like a doji. When you see equal wicks on the top and bottom, equal wicks are showing a tug of war in the market, right? We have bulls and bears. So bulls are on the low side, trying to push it back up. Bears on the top side, or sorry, it's on both sides. Bears are trying to push it down, bulls are buying it up. Bulls are trying to push it up, bears are trying to push it down. We end up closing relatively close to open. And let me find... Sorry guys, I should throw those in there. Here, give me 2 seconds. I will throw those into the chat. That's my bad. I didn't really think that through real quick. So, there's 1, 2, and you got the cheat sheet already, right? There we go. Whoever went and Googled that and found them and threw them in, Jordan or whoever it was, that was great. Next time we will start throwing the content in the chat right away. I think that's great that somebody pulled that out. I don't know if anybody has the original. Did you get it? Okay, there it is. Yeah, so that's what I kind of got on candlesticks. I don't know, does anybody feel that they need any more kind of explanation on candlesticks? Like I said, I don't know what every single one of those formations does and their significance, but I'm learning as I go. I know the ones that I do know, and the biggest part is just understanding the way that they are built, the way that a candlestick is built in its time frame, right? What the wicks start to signal and where the bodies start to close, right? When we see, let's see if we can pull up another one here. When we see a bullish candlestick come up here and close high of day, and we see a long wick after that can't sustain it, coming into a $1/2 resistance level, and we see a sell-off and kind of a spinning top, again, indecision in the market with similar equal wicks, right? So this candlestick really doesn't show too much significance, but it does in the sense that we saw an equal little battle here, and this would have been the candlestick to look for, is on the next day. So we saw an open at the low of this, or sorry, at the close of this candlestick. We saw another little push. We could not break, let's see, we could not break the high of this candlestick, right? And we ended up turning around, the bears took over, we sold off, and then, we came down to a support level here where the bulls ended up buying up a little dip. But essentially, this was the signal of kind of a bearish downtrend. We did see a massive dip this day with a big bull buy on the end. So this was a beautiful dip. Some people could have made some money. If you're an intraday trader, these types of moves, these types of long wicks are what you're looking for. Me and Jordan personally like to trade and really learn small cap momentum stocks, some of the stuff that Warrior Trading trades, Investors Live, intraday, big moves, Deckmar trades as well. They're great. The guys they're good, but they don't. Their focus is so just strictly on intraday moves. They only care about intraday moves. They don't plot for swings. They don't plot for long term. The chart guys, if anybody's watching any Charting Man Dan's videos, they really look at big cap stocks, Apple, Facebook, SPY. They look at the commodities, oil, gas, nat gas. There's a bit of cryptocurrency they're starting to get into. So they look at a lot of other stuff. They're also cover sectors, right? So they're covering the MJ sector. Sorry, I talked about oil and gas, gold sector, stuff like that. So to be diverse in the markets is what you want, and technical analysis can help you to do that, because trading is on all levels with TA. There has to be price action and there has to be volume. So we're going to talk about time frames just really quickly here, just before we get into volume. So time frames, again, we're on the 1 day chart, the daily chart. Many different time frames. I'll go up here. So you can pull up a 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 10 minute, 15 minute. And the idea is I like to start, if you're looking for a big trend or a weekly trend, let me just clear up some of these lines. Just going to duplicate a window here. And sorry guys. And if I'm talking too fast, let me know. I can get on a ramble and a roll here. Just get rid of some of these. All right. So time frame. So this is a weekly time frame. In a weekly time frame, you have 5 trading sessions, right? Obviously, we don't trade Saturdays and Sundays. Price action usually starts first thing Sunday morning in the pre-market, or I guess it's first thing Monday morning. Sorry, in the pre-market, and goes from there and closes in the after hours at 8 p.m. So each one of these candles represents 5 trading days from Monday to Friday, and this was the price action that we saw inside of those days. So you remember we had the downtrend on EMH. Well, look at it, it's still a downtrend, and that's how long it lasted for. So you got 1, 2, 3. We saw a two-week recovery, 4, 5, 6, 7 days of downtrend. When the final day being this kind of what was it? The gravestone doji. Gravestone doji, I believe, at the bottom of the downtrend. So let's have a look here. Dragonfly doji. There you go. So we came 1, 2, 3. We have a dragonfly doji, right? It didn't close at the high of the day on this one, but it came very, very close. And then we saw a reversal. So, you know, we can see that here. We saw a downtrend. We saw the dragonfly. Then we saw a reversal. Then we saw the April push into legislation. We saw, you know, not equal wicks, but we saw long wicks on both sides, which shows a lot of volatility in the market. Big sell-offs, big bull buys, big sell-offs up for bull buys, and then we came into a downtrend, and now here we are. We're printing what appears to be a dragonfly doji. The week is not closed, and what I said about candlesticks before was one of the most important things was the candlestick needs to close prior to confirmation leading into what's going to happen next, because anything can happen tomorrow. Tomorrow's Friday. It's also a very volatile day. So what I would like to see on this candlestick is I would like to see this push up a little bit higher and close at the top. And that could possibly signal some sort of maybe short-term or longer-term trend reversal, or maybe we could even get into a bit of a sideways pattern here. You know, sideways trading is kind of like this, right? We get a bit range bound, you know, before we maybe come up and see some sort of breakout with a back test off of resistance, right? Or to the downside, right? We could come down here to $1, break through, try and get back up to it, get over $1, it not happen, and go from there. So those are two, you know, the stock market is essentially 50-50. You want to go up or you want to go down. So, yeah, Mike, that's right. TGIF. We need a slogan that says, you know, BCTGIF. Be careful, or GLTOF. Good luck trading on Friday. Something like that. Most difficult days to trade. I agree with Jordan there. End of the month, earnings, Mondays, Fridays. So short-term and kind of long-term stuff there. But definitely Mondays and Fridays, I think are the hardest. And you know, I've started to take it easy on those days. I took a position on EMH today into the close. Tomorrow's Friday, and if I see what I'm looking for in some sort of gap up, I will take my profits off the table and be able to sleep comfortably over the weekend. Good luck this Friday. That's right. Is that what it is, Mike? Good luck this Friday? GLTF? Oh, good luck trading Friday. Yeah, I like that. So, yeah, so that's what we're looking at. So, you know, we're kind of printing this candle now, which we have seen as similar kind of, you know, trend-ish reversal candles along the way on these big dips with lower long wicks. And here we have one here now. So, you know, it's nice to see this. I'm not going to, you know, mortgage my house and put all my money into this stock, but I'm going to use it to hopefully plot my next move into this stock and take some profits off it. So that's the 1 week time frame. Then we can come down. So, and also, you know, you can open this 1 week time frame up to as far as you want. So this is all 2015, 2016, 2016. There's the November rush, and then we're into here into 2017, right around here, when we saw that big push out of the new year, you know, and a big sell-off. And then here we go. So, and this is kind of what, you know, I'm thinking of will happen next. Mind you, these two things could happen right out of here, or they could happen off of this one. But, you know, the idea is, and looking at the size of these kind of up and down movements, you know, we can get an idea for this is the type of patterns we could see out of this candlestick here. So, you know, this could actually kind of tilt off axis and pull down a little bit more and maybe possibly break up before or break down. But the idea is to be ready for it, to start to anticipate it, and to get a better idea of, you know, what's going to happen. So break it down to the 1 day time frame, which we're already looking at. Again, as you can see, you know, the kind of trend has this kind of softening trend. So my trend line stayed, but they only go so far on this one. So again, these are 1 day candlesticks. So price action from the open to the close of the day. So today's candlestick, we opened at 110, I believe. Opened at 110. We sold off to a low of 106. Everybody knows I've been anticipating the bounce off of 103. We didn't quite get there, but we were dang close. I mean, I missed it a little bit, but I caught some of the move. So this is why I was looking at it. Right? I took my trend line and my horizontal horizontal support line, and I found common points where we saw this 103 before. So we saw $3 here, we saw $3 here. Before, I was watching 118. I'll draw that across. Of course, I hit all those. Supports, I think support and resistance levels, some people will tell you that it has to be straight to the penny. I believe that sometimes, you know, there can be a little bit of a variance, a little bit of give or take there. We'll see wicks will go down, but we'll end up to close above it. So again, I saw 118, 118, and 118 down here. So that's what I was watching for that. So again, remember, candlesticks on your time frame, 1 day is open to close, and that is wick to wick, right? The open to close of the body represents something different, but the actual time frame of the candle is the low until the high. This is Questrade, Mike. Really good platform. Great for charting. Obviously, you know, just due to the visual aspect of it, and I enjoy it. I also have QuoteStream, which I use for kind of my raw data that I pull off of my level 2 and stuff like that. So I think probably in the next webinar we'll probably cover a little more kind of trending support and resistance levels, and we'll get a little more into platforms at the end of it and talk about kind of what we use and what we've seen. You know, that stock charts is great. You can go on investing.com. They have live charts for free real time for like commodities and stuff like that. Yeah, a lot of more customization. There's still some things that I can't do. Like I'd like to be able to draw circles and do a little more actual like paint work drawing on this. But I mean, the idea is, if you can see here, you know, you can set up a channel, so I can kind of run a channel like that, you know, stuff like that, right? So there's also some Fibonacci stuff, which I don't really get into, but the price line one for me is the best because you can kind of go in here, hit a price line. Another thing is I like is to go right onto the candle, and you can see the time of the candle, the open of the candle, the high of the candle, the low of the candle, the close of the candle, and the volume that was inside of that candle during that time frame. So again, remember, time frames can happen at any time, right? 1 month, 1 week, 1 day. A candle can appear on any time frame. It's what time frame you look at and the significance of the candle that really matters. So let's break it down a little more here into, I don't really look at the 2 hour, but let's look at the 1 hour time frame for today. Sorry, let me get rid of some of these. I'll just get rid of these support and resistance lines. So the gray lines here represent a day break. So here we are on the 10th. The gray is nighttime. We're all sleeping. Some of us are stressing about our positions. Some of us are not. And the next day is the 11th here. So again, 1, 2, 3, 4, 5, 6. Looks like seven trading hours in the day. Is that right? 7, 8 trading hours in the day? I don't even know, actually. I just stumped myself on that. 1, 2, 3, 4, 5, 6, 7. Looks like 7. I don't know why this one's sitting half in the gray. Maybe that's just because of a little bit of pre-market action. But yeah, so that's the 1 hour time frame. Haven't gotten into using it too much. I've just started getting into using the 15-minute time frame a little more to try and find setups, right? Because like I said, candlesticks show a significance and they show patterns on all different time frames. So as we were looking at the 1 day and the 1 week time frame, which you would use to plan a swing trade, right? If you wanted to get in on a Monday, possibly sell on a Friday, maybe sell on the following Wednesday, you would look to the kind of bearish or bullish patterns that were going on with the development of those candlesticks. Now you get into the 15 minutes, and now we're into intraday, right? So where are we seeing some kind of moves throughout this? I don't know if EMH is that good because it didn't have a lot of volume today. So let me just switch over to Weed. And I'm going to use the MJ stock charts because that's what everybody, for the most part, is in this chat room is interested in. So why not? Let's just move. Why not? Let's use these charts to plot. I really don't want to lose all my lines here, so I'm just going to duplicate this window again. I'm just going to pop out here real quick to the 1 day and just show you how kind of crazy I got. Whoops, I don't know what's showing all those bottom ones, but this is kind of how crazy I got on the Weed charting over the last couple days, and really I was trying to measure these kind of big gap downs between these two, and I'm going to do a measurement tonight on this gap down. But you can see we had a huge downtrend. I don't know if anybody got a chance to read the write-up that I wrote on Weed last night. I think I only sent it out to a few people that asked me, but we saw a high of 1330 on Valentine's Day, and ever since it's been a downtrend all the way down, with offering nice little dips, right? Nice little intraday or 2 and or 3 day dips on the way down. So I'm going to clean up these lines here, and maybe we'll revisit this chart in a bit, but it's a bit busy, and I want to keep you guys kind of clear and concise, and we'll just stick to intraday here and move forward. So a lot more volume in Weed, and we can see. So this is the day we saw today. I don't know why there's no gray line here, but this is actually this is the 10th here on this side, and this is the 11th. For the sake of maybe your eyes, I will put a line there if that helps out to kind of show you the difference in the 2 days. So we opened up in the morning, we sold off. We had a battle between buyers and sellers, right, between bulls and bears, and we kind of created this long wick spinning top, and then we popped up here and we tried to get into this moving average, which we're going to cover in a minute here, and we ended up selling off, and we closed down here on the low again. Then we had a doji-ish spinning top style candlestick. We opened here at a low, and this was our big bullish breakout. We got over top of these 2 moving averages on the 15-minute, and then that's when we started to move. Again, I'm going to talk about moving averages in a minute, but whenever you see a big overextension off of some moving averages, you can kind of think that it's going to be due for a bit of a pullback and a bit of consolidation. And then we ended up just coming up here and grinding this all the way up. So time frame wise, these are 15-minute time frames. So each candle, this has 15 minutes of price action inside of it. This candle will not close. In fact, you can see that on this, when you get a timestamp, 10:15, the next one, 10:30, the next one, 10:45, and 11 o'clock, and so on and so forth. So inside of each candle, remember that, you get 15 minutes of price action. So let's break it down one more time to a 5-minute candlestick, right? And all it's essentially doing is giving us more candlesticks. I'm going to remove all the drawings again. Again, this is the daybreak here. So we have now 3 times more candlesticks because we're showing 5-minute. Oh, sorry, I didn't get to. There we go. So 3 times more of the candlesticks, but the trend continues. But you can start to really, break down and see these pullbacks a little more and a little clearer. The bigger the time frame, the overall bigger picture and general trend you will see. The smaller the time frame, you will start to see what is called the whipsaw, and that is how the price action moves up and down in relation to. Just how the price action moves up and down and consolidates inside of each candle. So I'm going to break it down again one more time to the 3-minute candlestick. So each one of these candlesticks is 3 minutes in time, and there you go, right? So I don't know if anybody's got kind of any questions on that, but if you guys are happy, I will move on to the next section. I didn't want to cover too much time frame, and obviously I don't want this to run forever, but you know, we're going to cover a few more things here, and then we'll get into some Q&A. And one more time, there's the 1 minute. So the 1 minute is very volatile, you know, and if you're buying and selling on a 1 minute, you should really only be momentum trading and looking for your exit and entries, because if you see there, you know, you've got a 10-cent difference between that, but out of this, if you're watching each individual candlestick, you're kind of thinking, oh, what is that trying to form, and what is that trying to form? And when you blow it up a little bigger to a 15-minute candlestick or a 5-minute candlestick, you know, this price action smooths out a little more. And when you blow it up to a 15-minute candlestick, you know, you really don't see that much. You see the long lower wick where you did see that low and that support, and you see that resistance level, but really 1, 2, 3 candlesticks stayed right kind of in this lower low of this candlestick and the higher high of this one. So really no reason to get out of the trade. Just stay in, consolidated, touch the moving average, and continued on through the day. So, you know, again, we'll start to talk about trends, support, resistance levels in the next webinar. This one is just to get you the basics of terminology and, you know, what we use, the tools that we use, and how we interpret them, and, you know, developing your skill in technical analysis. So the next one I'm going to talk about is volume. I really don't need to get too crazy into volume, but I'll talk a little bit about its significance. And let me pick a good chart. So let's look at November, the November bull rush, because that one is the best. So if you can, set your charts up like this on the histogram so you get bull volume and bear volume. Bull volume, that's what we want, right? If you're going to be bullish, obviously. If you're going to be short, you want bear volume. But I don't think anybody shorts in the group. Maybe John Smith or a couple other guys that are a little more experienced. I've only ever done one short. It was successful, so I'm 1 for 1. Pretty happy about that. You know, and I'll strive to go for 2 for 2. But in the meantime, I only watch bull volume. Volume is the most you know, aside from stock price, volume is the second most, and if not the most important aspect of technical analysis. Volume represents us, the traders. It also represents, Joel shorts, right? Joel's got a big set in his pants, so he likes to short overnight on earnings, of course. Where was I? Yeah, volume is the most important thing. It represents the market, it represents the audience, and it represents the transactions and the liquidity in the market, how much money is in each time frame, how much money is exchanging hands at any given time. So, you know, we can see this bull volume rising up, you know, and then obviously we had a big sell-off, and this turned into bearish volume on the way down, where we saw bull and bearish volume, and then we saw declining bear and bullish volume, and declining bear and bullish volume, where we kind of came into this consolidation. So usually when you see big spikes in volume, either on the bull side or on the bear side, is where you start to see these big giant spikes in volatility to the upside or the downside, right? And they don't have to be big and giant, but they show representation of what's going to happen in the market. So I already kind of did these ones, right? And then the overall trend to here, which was the overall trend, and then you have also down trend bearish volume through these ones. And then when the volume all dries up, we usually see consolidation. And consolidation is when there's consolidation, you can look at essentially as, you know, on a bigger time frame, you would see it as a doji or a spinning top. You would see it with equal wicks on the top and bottom, which would show hesitation in the market. The bulls and the bears are in a bit of a tug of war, but no one's really jumping over each other to, you know, slap the ask or slap the bid and drive the price one way or another. In the volatile market, you can see clearly that's what happened here. This is people buying on market. This is people buying on. Slapping the ask on the way up, and this is why we get these big giant volatile moves that happen in all time frames. They can happen on a 1 minute time frame where you see a huge spike. They can happen on a 5 minute time frame, all sorts of time frames. So volume is a huge significance in that, and that is what you want to look for. You want to look for increasing volume to signal some sort of a breakout. You want to look at increasing bullish volume to signal a breakout, and you want to look at increasing bearish volume to signal a breakdown. So We don't see it as animated on this side, but you can see that the general sentiment over here is mostly bearish, kind of from these last two little bullish climbs here, especially after the dip. But after that, each candlestick has a correlation, almost direct correlation to the bearish volume that we're seeing down here. So, I still learning a lot about the real significance about volume. Chartman Dan, he drives it home every time he makes a video. He always points out volume, and I'm really trying to point it out more and more. And even just talking to you guys about this now is helping me drill it in my head to really pay attention to volume on all time frames, right? So today, let's go to 15 minute of today, which would look kind of clear. And that's exactly what we saw. So we saw the gap down, a low of 737, and then look at this rush of bull volume, right? Now, granted, the overall trend was some declining bullish volume, but it didn't matter in this case. People were buying on the ask, and people were getting this thing moving. Even on this big candlestick, we didn't see as much here, but this had a lot of exchange of hands. This had people selling, shorts covering, bears trying to drive it down, bulls trying to push it up, and at the end of the day, the overall volume sentiment was bullish, and that's why we ended up with a green stick here. And just in that 15-minute candle, 817 shares traded hands. I don't know if anyone has a calculator in them, but in 15 minutes, let's take an average price here of $7.50 times 805,000. Can someone tell me what that is real quick? I don't know what it is, but just to give you an idea of how much liquidity, how much volume, how much money exchanged hands in 15 minutes, that is what you want to look at. And the more money, the more liquidity, and the more volume will be the more drastic moves to the upside or the downside. Remember that. It goes both ways, right? And this is a perfect example of red to green. We saw all bearish volume on this side, all bullish volume, sorry, I should be down here, all bearish volume here, and all bullish volume here. We did see a big increase in bullish volume at the start of the day, where it ended up drying out a little bit. Similar to the following day after the gap down, we saw a big bullish volume. $6 million, Joel, in 15 minutes. 6 mil changed hands. I only know of a few people that bought into that with 1,000 to 2,000 to 3,000 shares out of that little piece of the pie. So shave a bunch of zeros off of the left side of that, and that's what our crew is. That's our crew's little market share in the weed move this morning. So when you start to break it down like that, it's unreal. And always remember that volume to get the liquidity of a time frame. Right, you can just multiply the volume by. I usually go by the average price of what the candlestick was. So especially if it's this type of candlestick that kind of closed in the middle of the two wicks. So that's kind of what I got for volume. I don't know if anybody has any questions about it, but pretty straightforward. Just remember, volume is us. It's the exchange of shares traded in a time frame. So, and that's what you want to look for on each candlestick. So, not a best example here. Maybe we'll use. See if I got one. I was hoping for. I saw a nice bull volume on the upside. No, I don't have it. I don't know where it is. So that's why I showed you the 6-month 1-day, so you can get a good idea of what it looked like on a big bull rush, and then you can see a bit of a bearish sentiment and takeover. So I will move on to our next little section here, where we're going to talk about indicators. There's two types of indicators. We have leading indicators, and we also have lagging indicators. So leading indicators are created to precede the price movements of the security by giving predictive qualities, whereas lagging indicators are built on previous price action and have less predictive qualities. So the two big indicators that come to mind that I use are moving averages and the RSI, the relative strength index. Moving averages are obviously lagging indicators. They need past data in order to plot. That's why you'll only ever see moving averages. You won't really see moving averages on IPOs until candlesticks and price action start to form. if you pull up ABCAN on the weekly and look at a 9 time frame moving average, then you won't really see anything because there hasn't been 9 days of price action yet. So the widely used indicator is the moving average. SMA is a simple moving average, EMA is the exponential moving average, and all they do really is they filter out the noise in price action. So I used to run 4. I used to run a 9 time frame, 20 time frame, 50 time frame, and 200 time frame. I'm just now trimming it down where I'm only running 2. I'm running a 9 and a 20 time frame. So the number is significant to the moving average. You can select it. You can select it at 1, 2, 5, whatever you want, 200, 300, 500. But remember, it's for a time frame. And as we just learned about time frames, it doesn't chart the price action over the days, it charts it over the candlesticks, right? Each candlestick is a time frame. So this looks at 9, from this candlestick here, you're going to look 9 candlesticks back, and it's just going to smooth out the price action going up to it, and then you'll see this little dip here, where you saw a little dip in candlestick, and then if you move forward to maybe these ones, it will look 9 back, right? So about here, we come up on this moving average, and then we take a little dip and go from there. And if I hold my cursor over it, to the right side of the screen, you can see the top of this moving average was $11 roughly. This is the 20 moving average. Right around here, the same one is $9, right? So the average, this one goes 20 time frames back, right? So it starts its calculations and adding up here before it gets up to here, which will give you $9, which is a little bit of a lower average. So the higher the time frame, usually you're going to get the lower the average. Now it depends on where the price action is in relation to the moving average, if it's below it or above it, and if it's a bullish or bearish market. But that is kind of the gist of time frames and moving averages. Like I said again, I like to run the 9 and the 20. So looking at price action individually, we can kind of see that we're consolidating here and trying to get over these moving averages and turning them into support and resistance levels. And like I said earlier, that whenever we see kind of a big separation or a big high move off of a moving average, we will see usually some sort of correction and come back and test it as a support, right? So it came back here and it tested it as a support level. It wasn't an absolute due to the wicks, but the candles, like I said before, the importance of the close of the candle is over the moving average, and that's exactly what we saw. So we then moved up again, we got a little bit highly extended, we came down, and this is where we're starting to get into dangerous territory where we're closing on a moving average, and unfortunately we had a gap down here where we closed underneath this moving average, but above the 20, we moved to the next candle, we closed above it, but the bulls couldn't take over, we popped up to a high, looks like $12.50, so the $half resistance, and then we came down here, closed below the 9 moving average, and that was it. We were stuck under this blue line, these two moving averages crossed, and then we became stuck in this downtrend underneath this moving average for, well, until almost today. We are still underneath this moving average, which acts as a crucial resistance point, and that is why a lot of people are saying that this downtrend could be short-term, because we want to see these candlesticks start to move and close up above these moving averages. So again, probably save it for the next webinar to get into the technical stuff and trending, but that is kind of the gist of how candlesticks and price action work in relation to moving averages. The difference between the SMA and the EMA, I run the exponential moving average and the simple moving average. So the simple moving average is simply just, it's exactly what it sounds like. It's calculated by adding the closing price of a security over a number of time frames or a number of time periods, then dividing that total number of time frames by how many you had. So that's how you figure out an average, right? You got 15 numbers, you add up all 15, and then you divide it by 15. The exponential moving average is similar, except for it gives more weight to the more current time frames in that moving average. So if I'm looking at a 20 moving average, so I go 20 kind of candlesticks back, probably around here, it's going to give significant more weight here and try and move this moving average a little faster. Remember, it's a lagging indicator. It needs price action to be complete before it can continue. It does not predict the future, and it never will, but it will help you to find support levels that kind of flow with your charts and flow with your candlesticks. So they're a great indicator. I like I said, I used to use 4 of them. Now I use 2 of them. I can see a lot better. That's one thing I also want to tell you about indicators. Do not put 100 indicators on your chart. I mean, you can go here and you can put, you know, Bollinger Bands, and then you can put stylistic fast, stylistic slow, and you can just end up becoming blinded by all of these indicators and things that you think are the holy grail. And we're going to talk a little more about that when I wrap up the indicators. So the next indicator I'll move on to is the MACD. It's the moving average convergence and divergence. And everybody still hear me okay? And as following along, I think I just blacked out and went on a moving average rant. But let me know. I got the last thumbs up I see is Chris, so shoot me another one to make sure you guys are still following along. My phone hasn't been ringing, which means I hope you guys are still there. Maybe you're not. Hey, there's Joel. What's going on, Joel? Okay, so if I talk too fast, please just tell me to slow down. And but the good thing is we're recording this, and it'll be up available for anybody to watch it over and over again. And we're going to leave this chat room open, so if you guys are still a part of it, you can always scroll back at the end if you have any questions and kind of revisit them and revisit any answers that Jordan gives you as well. So the next lagging indicator that we have is a MACD. I will pull it up here. So the MACD is not an overlay, it's actually a below indicator, and the MACD shows trend reversals essentially. So it's a trend following momentum indicator. It shows the relationship between 2 moving averages of prices. It is calculated by subtracting the 26-day exponential moving average from the 12-day exponential moving average, and there's also a 9 exponential moving average, which is called the signal line, and it's plotted on top of the MACD, and it functions as a kind of trigger for buy and sell signals. The 2 lines that compose it, again, they're called the MACD and the signal line. These lines will move together, except one line will move faster than the other. The MACD will move faster than the signal line, and the signal line is a moving average. So that's why, because you have 2 moving averages that are calculated off each other, and you have 1 actual just moving average. The histogram below it shows the distance between the 2 moving averages. So the histogram runs on 0, and you go a positive or a negative, right? Depending on if you're an uptrend or a downtrend. Again, we talked about overextension off of this moving average. Again, down here, because these are moving averages, we look for overextension, and that can signal kind of overbought conditions. And then we can, or oversold if you're on the downside. And as soon as we see these kind of crossovers, is areas like this where we see a kind of trend reversal. This one, not so much, because this was a bunch of jargon. You know, it was up, down, dip, up, down. But when we see a nice long trend and then we see a crossover in our moving averages, then we look to a downtrend. So this is a good example here where we were kind of consolidating. And I'll just go down here. We were consolidating through price action. And we started to climb. We started to climb into the end of mid-February. And that was when we crossed over. Now, if you look, the crossover is here actually at February 24th, but I plot this downtrend start kind of around here on Valentine's Day, on February 14th. So that's where I take my trend lines from, is here. Because of this short-term dip, and it was a quick one-day sell-off, we still had quite a bit of extension off of the signal line had quite a bit of extension off the MACD line. Signal line off MACD, yes. And then that is when we kind of rolled over, and then we turned into this downtrend, and we had a little bit of extension, but not a lot. And if these 2 lines stay close together on a downtrend, you actually want to wait for a big overextension where you see it kind of hook around, come up, and pop through. And that's exactly what we saw here. And these are the dip buys and plays that we see through this, and you can see that the price action, how it rolls through this, that my 2 moving averages up here. So the MACD is great and all, but you can get a lot of information just running moving averages on your charts. I do run it sometimes, but I really don't look at it too much because I have those moving averages, because I'm familiar with this overextensions and what usually happens after them. This information down here is derived off moving averages, so really, you know, it's the same kind of thing. It's up to you if you want to add it into your technical analysis and how you use it. again, don't blind yourself. Don't put too many on there. You can put 7, 8, 9, 10, 15 indicators on there, which will not only lag your charts and your real-time charting, depending on how fast your computer is, but it will also just blind you and, KISS, right? Keep it simple, stupid. That's something that I learned back when I was, what was I in? Sales or something like that. Keep it simple, stupid. Don't deliver too much information to somebody where you overload them. And that is exactly what is happening here if you put too many on. And that is why I cleaned up my charts. And, we're just starting with the basics for you guys. And hopefully I'm not overloading you with too much information. And, you guys can take something out of this. Even if you take one thing out of this and it helps you better your trades in the future, I will feel complete. And please let me know if that happens. If you say, hey, Orion, thanks for showing me the moving average. It helped me find a support level. And, I managed to get out of it when it broke down through the moving average the following day, or whatever it is. So we'll go into RSI real quick. So RSI is a leading, that's stochastic. See, there you go. Stochastic, fast. I've never even looked at that. I have no idea what it does. I will read about it one day, but I don't use it, and I don't think I will ever use it. But RSI, people are familiar with the RSI and the relative strength index. It's a leading indicator, and it provides a relative evaluation of the strength of a security's recent price performance, thus making it a momentum indicator. The values of it are 0 to 100. It runs on a default time frame for comparing periods, up periods to down periods. The time frame that it runs on is 14. So you can see this shows a 14 here, and it can show it'll show what it closed at here, the RSI, which you'll already see over in this area. So it compares the magnitude of recent gains and losses over a specified time period to measure speed and change of price movements of the security. It's primarily used to attempt to identify overbought and or oversold conditions in the trading of our assets and our stocks. So normal range is between 30 and 70, and if we are to use the RSI as an indicator, we want to look at it for it to be out of normal range. So under 30 would signal an oversold indicator, and over 70 would signify an overbought indicator. Depending on your trading plan, generally the 5-minute time frames or higher is what you would look at. Remember, this all goes off of time frames, so your RSI on a 1 minute is going to be different than a 5 minute, and different than a 5 minute, than a 15 minute, and so on and so forth. So today, this is what we saw. Oops. We saw some oversold conditions down here at the end of day yesterday, and that is when we saw a bounce. So we got under this normal range of 30, and we bounced and we backed up in the normal range now. And you can see on the downtrend here, the RSI never actually broke out of normal range. If I break it down onto a 5 minute, break it down onto a 5 minute, you can see the RSI is showing a lot different data than it did before. So we ended up having a really low RSI of 9. Anything under 10 is an immediate buy. If you hit an RSI of 10 or lower, I believe Chartman Dan these are words out of his mouth as well. It's pretty much an immediate buy. Jump in and obviously have a tight stop loss because it could sink a little lower, but look at the recovery out of a 9 RSI right back into right back into normal range. And then this is where we saw consolidation through the normal range. So we're looking on the 5 minute on weed, and this is where you can see some consolidation, right? And then we started to launch off, and this is where we started to move up to the higher end of the normal range. And it's very nice. We stayed right into this kind of higher quadrant of the RSI. We only really popped out over 70 and out of normal range once. Because we stayed in the higher end, it's signifying that it's not just overbought, it's being bought well. It's being bought on the ask, and it's bulls getting in, and that is a nice bullish uptrend continuation. I mean, gorgeous chart today, beautiful move. Hopefully people made some money. We saw some little bull flags along the way. This is a bull flag on a 15 minute probably. Should pull up a 15 minute real quick. Actually, pull up a 10 minute maybe. Yeah, we saw a little bull flag here. These are little micro pullbacks, right? And these are places where you can enter, basing off of set risk versus reward, basing off a lower support level, getting in, and if it breaks down, we could see a signal of a reverse of trend. So again, remember your candlesticks and your patterns. I will put out another cheat sheet of some more patterns in the next couple of days where you guys can see some kind of momentum patterns to look for. Bull flags and pennants and stuff like that. They happen on all time frames, and they can be used to find entry and exits and build a risk versus reward. So that's RSI in a nutshell, real quick. I don't know if anyone has any questions about it. I know Tim, I think Tim or Mike, one of you guys were really interested in how RSI works. The biggest takeaway I can say is remember that every time frame will show a different RSI. It doesn't necessarily mean that because you saw a 10 on one time frame that you're going to see a 10 on another. But here we go today on a 10-minute time frame. We're seeing, well, perfect example. I showed you a 9 on the 5-minute time frame. On the 10-minute time frame, we're seeing a 12. So there's a perfect example. And then I believe on the 1-day time frame, we ended up seeing it was just under. Let's see here. Yeah, we just cracked under. So 24. So use that how you will. Play around with it. Throw it up on your charts. Skip through the time frames. Watch some moves. The best thing to do is not just watch current market, but just open the time frame at the end of the day and look at weed for today even, and do what I'm doing. Go back 3 months or 2 months and look at it on the 1 day and start to take notes of what was going on in these areas, and then look at it at the same area on a 1 hour or 1 week or 15-minute or whatever you need to do to start breaking it down to, I wouldn't go lower than 3 minutes really. You can go down to the 1 minute if you really want to see what it looks like and the difference, but take some notes and start to compare and learn from that. So if you start to see, this type of RSI on the daily, there's a good chance that on a smaller time frame, that RSI is probably going to be deeper down into this lower quadrant, which could signal intra-move buy and possibly some profit taking, right? So that's what I got for that. Again, there's no one perfect holy grail of indicators. They're all to be used in conjunction with the current trend of price action plus volume. Essentially, you just have to take the right pieces in order to create your own puzzle. And that's what I've done. I've got 2 moving averages. I run an RSI and I run the volume. And I've mentioned RSI to some other people, and they're like, "What? Why would you use RSI? That's pointless." And I use the MACD, and this person used that, and that goes back to don't compare yourself to other traders, other investors. Just do what works for you and figure out your own thing. And if you understand it the best that you possibly can, and it's still not helping you, then try something new. Try and swap it out for something else. Maybe change your moving averages around. I know John Smith runs simple moving averages. I run exponential moving averages. We're going to get different data, but guess what? We end up coming up with the same conclusions. So that's why I say it's about building your own puzzle and taking little pieces of this and using it to move forward. So that's kind of all I got, guys. We're just over about an hour here. Yeah, I feel that for the basics, these are great foundation building blocks to work off of. These are what you need in order to complete thorough technical analysis. Without all of without candlesticks and price action, and without volume and share exchange, you cannot work and to build a nice complete package of technical analysis that you can use to help you better your trades. At the end of the day, we want to buy low and sell high. Obviously on the bull side, if you're on the bear side, you want to sell high and buy low, but just let's speak for a bullish perspective, buy low and sell high. How do we do that? We do that by finding the bottom or close to it and selling at the top. And these are the tools that you can use to do that. These are the tools that millions of traders use all over the world every day. This is why I'm not knocking fundamentals at all. Fundamentals are great, and I think if you have a combination between fundamental analysis and technical analysis, you can be one of the best well-rounded traders. That's why I like Brian Judge and Miz and these guys, because they're being exposed to technical analysis, but they have such a great fundamental background that they see low valuations in companies and they know when to get in regardless of what it is. But to be able to find bottom in a short-term trend or a long-term downtrend, or know when to take profits in any sort of an uptrend, hey, why not mix the two and get the complete package? Here's a perfect example here. So I would imagine a lot of people bought in this 850 downtrend, and then we came up and we kind of traded sideways, right? And I don't think too many people would have sold. Definitely some traders sold through these moves. But let's say you took on a 10,000 share position of wheat. Okay, that's maybe a bit extreme. That's 80,000 shares or $80,000. But just humor you for a second. A 10,000 position, share position, and you were kind of watching this 1040 range, which ended up putting in a top for resistance, right? And then you had a nice big breakout to the upside. You broke out to the upside to 330. I know it says 326, but 330 here. You saw some overextension here. You're holding $80,000 worth of this stock. You're starting to see overextension. You know that is can be a trend reversal. You're starting to see it break out a normal range on the RSI, and all of a sudden you decide, you know what, I might sell some of my position and get out of this trade and take some profits off the table, because I kind of think I am seeing this starting to form a trend reversal. This is where you dump maybe half your position. You could pop off half your position. You would have taken a $5 per share gain, right? Come down here, you found a support level. Okay, I'm still well above that. And then that is where you would have some sort of a stop loss in here, probably a stop loss at this 1041, because this was a crucial resistance level. And when we broke out of this resistance level, this was a crucial support level on the way down. And this was the big test of it. This is where we tested it. We came up for a short-term recovery. We could not get over these moving averages, and we sold off, and we came down again to find a low of 951. So, if you bought at 851, you would go through essentially an emotional roller coaster, which I don't know if anybody remembers, but there you go. There's your emotional roller coaster, right? So you bought in here in optimism and excitement. You got up here to euphoria. Let me just try and put these side by side really quick. Geez, where'd it go? There we go. Right? So you bought down here, optimism, excitement. You came up here. Obviously, the chart doesn't look identical to that, but the idea is the same, right? You're in a bullish move. You broke out of resistance. You came up here to euphoria. Hey, this stock's going to the moon. Well, guess what? That's a big move from $8 to $13.30. A lot of red flags along the way. Overextension, not a crazy high RSI, but high enough to get out of normal range. And then you start to sell off. Here we are in anxiety, right? Oh, we had a short-term recovery, bit of denial. We came down here into fear, right? And then we sold down to a low of, what did we say, 951 was that low, where you are now $1 over what you bought in at. So, again, a short-term recovery, but look at trend reversal. We didn't get over the moving averages, and we came down. And my example for this is, if you applied technical analysis, if you applied fundamental analysis on buying because you saw low valuation in the company, and you applied technical analysis up here as well, you could have walked away with some profits and kind of, left this whole big downtrend. And what did we see a low at today? $7.30, and we are back at $8.50 to the close. So, that is the roller coaster of emotions that you go through. Let me just pop that up one more time. And the idea behind technical analysis is to start to eliminate those emotions and come up with trading plans that you can base off of, and indicators that can show you when to get into a trade and when to get out of a trade. And I say trade as a vague term. I don't mean trade as an intraday trade. I mean it as an entry and an exit, because it is a trade. You're trading your shares. You're trading money for shares. You're making the exchange. So when I use the term trade in any way, talk, text, print, smoke signals, whatever it is, I mean it in the sense that entry and exit. If you're a long-term investor, you want to find a low entry and you want to take profits along the way, because at the end of the day, you could hold, Apple from 60 years ago, but if you never sell it, and you never pull any money out of it and take profits off the table, what was the point? To show that you bought low and sold high? Or, sorry, you bought low and you were right? The idea is to take money off the table and put it in your pocket, right? Everybody wants to buy a new car. Everyone wants to spoil their kids, buy a new house, whatever, have extra cash, buy a boat, trade more, invest. I mean, there's money makes the world go around. Fortunately and unfortunately, and fortunately, we have technology nowadays that we can use our computers to make money from home or anywhere in the world. So I think that's amazing. Before you had to call into a trading floor or go to a trading floor. Now we can do it from our home. So back to this kind of emotional roller coaster again. Wow, I feel great about this investment. Point of maximum financial risk. That is when you have, and the financial risk is essentially your potential profits. If you don't sell up here and you ride this back down, when you get back down to this area, and you were once up at $13.30 and now you're at $8.51, you start to get this emotion of potential profits that you once had $10,000, you once had $5 or $5,000, you were once up this much. And once you get down here and you get into this fear area, you start to see maybe the markets just aren't for me, right? Maybe they're just not for me. And you start to say things like that, and you start to sell off your positions and take heavy losses. Yesterday, I know some people took some heavy losses in our chat group, and today we had a big recovery. So I stayed liquid, I stayed cash, because I saw the big long downtrend, and sure enough, here we go. The market works in waves, and what goes up must come down, and what goes down must come up. And you should always try and remember those things and apply them alongside with technical analysis, because there's nothing worse than selling for a huge loss when at one point you had a huge gain. I mean, I can't think of any worse emotion that totally messes with your head. And then how can you go into another trade with a clear head thinking about that? You're always going to think about this potential profit and how you're going to get it back, and this battle, this uphill battle. When I take a loss, I'm starting to train myself that was it. I took a loss on ABCN on Monday. I bought it on Monday at $1.05, and I sold it on Tuesday at 95 cents. I had 2,500 shares. I took a $250 loss. Come Wednesday, I erased that loss from my memory, and I only focused on the charts and finding this dip today. Today I made a trade on EMH. I made $180, and I am holding a position overnight, and I'm hoping to sell it in the morning for a $100 or $200 gain, which, hey, if I want to look at it that way, will pay for my loss on Monday, but I'm not looking at that. I'm just looking at starting fresh and looking at a new trade and finding myself, trying to make trades to the upside. I don't want to make trades to the upside. Nobody wants to buy high and sell low. We want to buy low and sell high. So, you have an equilibrium kind of here between optimism and optimism. Equilibrium is your break-even stop loss, get out unscathed point, and that is what people need to remember, that when you start to get back, you were up let's say $500 and you start to get back to zero, you should probably sell your position and get out, because after that you're either going to go down into this low belly of emotion and you're going to sell for a loss. I mean, 9 times out of 10, most people get down here and they sell for a loss. I don't know many people that have ridden it all the way back up. Maybe possible to break even, but to recoup those euphoria potential profits that you were holding on to. And then that's kind of my little emotional rant. I don't know if some of you guys watched my YouTube video on emotions. I'm gonna really build some good slides to that and talk about it. I feel passionate about that, and I think if you can control your emotions, you can control your mind, and essentially be a robot, you can make a lot more money. And it doesn't matter if you're a fundamental trader or a technical trader, it will help you no matter what. Fundamental traders that buy low, close their computer, and don't look at the market for 10 years and sell at a high, those are the guys and girls that we should be looking up to. But unless that's your trading plan, then I won't see you in the chat room every day, and we won't be talking about trades. You will have bought your stock, and you'll be living your life comfortably and not concerned. I mean, I don't think that's the best idea, but it is a strategy that people have. I think it's better to keep an eye on the market, maybe not sit in the chat rooms like us every day and try and find plays. But if you're a swing trader, you really don't need to be watching every single day. You need to keep an eye on it probably 3-4 times a day with a stop loss and a target zone for taking profits. But for the most part, if you're a swing trader 1 to 5 days or day trader terminology is 3 trades in a 5-day period. So I say swing trader is anything over 1 day, but the term day trader is actually intra-week. So technically, a swing trade is longer than a week. But regardless, the idea is to not be so attached to the markets if you're a swing trader, and really just buy some stock and plot out your risk versus reward and your support and resistance levels. And when you get up and over that and you get into the profit zone, take your profits off the table, sit back, wait for a re-entry, or find a new stock. And if you're intraday like myself, you're living kind of candlestick to candlestick, 15 minutes to 15 minutes, and you're going from there. I do like to swing trade as well. I'm not a big long-term holder. I actually don't have those emotions under control to hold a stock and not look at it, because I enjoy helping out, running the chat room, giving you guys support and resistance levels. And if I'm going to be doing all that, why not just intraday and swing trade? So that's what I got for me and the lesson plan and emotions. Again, it's been great to have this support from the chart guys. It's great to have support from you guys. Really enjoying meeting everybody through our secret chat rooms. My wife likes to laugh at me like, oh, you just have a bunch of online friends that you chat with all day. It's kind of creepy. What is this, 1995? Yeah, you know what? It is, but we're all working together for a goal to make some money and provide for ourselves and our families. So, I mean, at the end of the day, that's what we're looking for. I remember I had a crush on this girl, Cherry Blossom. She was in the chat room. She was in Kitamat. Never forget that. Anyways, yeah. So I'll open it up. If you guys have any questions that I went too fast over, I don't know, we'll take like 10, 15 minutes. And she's just jealous. Easy there, Gina. Easy. And let's see if you guys have any questions, if I missed something. If it's a question about something that we're going to cover in the coming weeks, then we'll just kind of save it in our back pocket and we'll bring it up then when we're going to build our next lesson plan. But again, the charts I run I run the 1 day, I run the 5 minute, and I run the 3 minute. Those are kind of my main charts. I do like to look at a 1 minute chart, but I used to really look at a 1 minute chart, but Jason from the chart guys told me, you know what, it's just too much data and it's too much information at once. Again, I also used to run 3 charts, so I would run up in the left corner, I would run a 1 minute, up on the right corner, I would run a 5 minute, up on the bottom left, I would run a 1 day, and then I would run my level 2 on the right. So that was also too much data. So again, I'm starting to clear up how much information that I'm taking in at a time, and I suggest that you guys do the same. So I'm now running 1 chart like this, and when I want to get to another time frame, I just go to the other time frame. I don't have 4 time frames running up, because the problem is you will try and did we cut out, Pat? Oh. The problem with too many time frames is you will keep looking for resistance levels and support levels down, 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 and you can be misled into a lower section. So I don't know if we're still cut out. I know there's about a 10-second. Okay, we're good on there. Yeah. So again, too many time frames. You can end up starting at the 1 week, and then you go, oh no, there's a support level on the 1 day, or the 1 day, and then oh no, there's a support level on the 1 hour. Oh no, there's a support level on the 15 minute. Oh, there's a support level on the 5 minute. And next thing you know, you just chase support levels lower and lower and lower, or you chased well, you wouldn't chase resistance, but you chase support levels, and you ended up finding yourself in a losing trade. So yeah, again, that's what I got. I don't know if you guys have any questions, but feel free to ask away, and I will open up a chart and see what I got. I know somebody wanted to see RTI chart real quick. I believe it's Radiant Technologies, and have a look at what I see on RTI. This is the 10 minute. Let's open up that was Tim, that was you on the RTI chart. So let's see here. So on weed, we were looking at the downtrend kind of around I called it February 14th. So it took a little bit of a different turn here. So February 14th, we saw the same kind of dip, and then we actually went up to a high on the 22nd. Let's just pull up wheat again. We went up to a high on the 22nd. And on weed, this is where, here's the 22nd here. So I don't know if you can see that. Tim? The 22nd is actually this. So there was that little dip off of Valentine's Day, and then we went into a high, and then there's the downtrend on weed. Now let's look at RTI. Same thing. So a little bit different. So here's our high on the 14th, a little bit of a dip. We ended up pushing up to a nice high, which is the year high. And then here we are in the same downtrend that weed is following, and we didn't get the move today that we got in weed. But we did, if you remember, create, it's, you know, in between a doji and a kind of, you know, dragonfly candle, interpret it to how you will. But what I do look at is we had a lower wick, and the bulls bought it up, and we started to close towards the high of day. High of day looks like it was 48, but you know, there's only 2-cent movement on that day. And also we didn't see a lot of volume, 750,000 shares of volume, whereas some of these other days where we saw, you know, a day range of low of 51 and a high, a day range of 8 cents, we saw 1.6 million shares in volume. So, you know, that's, Tim, that's kind of what I start to look for as I start to look, okay, where are we at here in the price action? Where are we at in the volume? What happened in other days where we saw bigger volume, bigger price action, and what kind of candles were developed in what time frames? And then because this sector is so tightly knit, that's when I start to look to the market leaders like weed and APH and stuff like that, where all of these dips were the exact same across the board. This was Spicer's comments in March, I believe, if everybody remembers. Well, yeah, you know, blah, 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 whatever he said with his big mouthful of gum. And then we saw a big sell-off, and then we had a short-term recovery, which was 1, 2, 3, 4 days. So if you bought here on the low, you could have swing traded this for 4 days, low of 56 up to a high of 73. You're never going to capture the whole move, but you can come close, right? Even if you got, what do we say, 56 to 73? I mean, if you got 10 cents of that move and you had a nice chunk of shares in there, you know, you had 20,000 shares or something like that, that's good money, right? That's, what is that, 20,000 shares, 10-cent move, 10 grand? Is that 10 grand? No. 1 grand, $1,000. Yeah, so, you know, I see the same downtrend. I see stuck under the moving averages. I'm not going to draw any support and resistance levels. I would want to see a break of the high of 49 cents. Always look to the last candle, the previous candle. Yeah, Joel, my math was off there. Would be nice if it was 10 grand on 20,000 shares, wouldn't it? On a 10-cent move. Yeah, so, you know, look to the high of the previous candle, high of 49, and that's what we want to see break, is the high of 49. If you look, the moving average, 9 moving average is also 49, so those are kind of two things I would look at. If we see a high of 49 break, I would start to look up, probably not at the next candle, obviously it's 50, yeah, okay, so the $0.50, like to see 50, and the idea is, Tim, is if you're going to see some sort of move up, you know, maybe we'll come here. These are some possible options. Is I'd like to see a move up, and then I'd like to see a back test for confirmation that we've built a new support. Same thing here. I'd like to come up, if we were to do it earlier, see a back test, right, before we do some sort of move up. The other option is, you know, that was the low 46. We would want to see come down to 46, you know, bounce off 46, come down, bounce again, keep multiple testing it before we saw some sort of move up there. So a couple of ugly lines for you there, but, you know, that's generally the type of price action that you want to see coming out of any sort of trend. To get out of the trend is the back test. The back test is crucial because it starts to solidify that a new support has been made, and it can take off for there up towards the next resistance. It's like if you had superpowers and you were jumping through floors. You know, you jump off the floor, jump up through the next one. You want to be able to turn your invisible superpowers off for a second, land on the next floor before you try and jump up through the next one. Totally weird analogy. Don't know where I got that from, but that works for me. I come up with weird stuff like that all the time. So, anyone else? If anybody else has any questions, please let me know. If not, I think we'll wrap it up, and hopefully you guys can dream about candlesticks. My suggestion is run candlesticks. Do not run mountain charts anymore. I don't want to see any more mountain charts or bar charts. And this, we're not dirt bikers. We're technical analysis. We're technicians. So we need data. What is shorting? As someone who doesn't obviously short, is it something I can see and save myself from getting burned at? Shorting is when you borrow shares from a security. So I shorted gold miners once, and shorting is the opposite of buying low and selling high. What you do is you borrow the shares from a security. So let's say you borrow the shares at, let's use this one right here. You borrow the shares at 74 cents. It'll show a negative amount in your account, negative amount of shares because you've borrowed them. The stock price falls down and keeps going and going and going, and you come down here to 46 cents. You then repay the brokerage. You have to buy your shares back. So that's why it's called short selling, because you borrow the shares, you actually sell them on the top. And as the downtrend happens, you have to buy your shares back at the low end. You buy them back from the open market and you give them back to your brokerage. It all happens internally with Quest Trade. Let me see if I can open this up. So yeah, you sell it. It doesn't really show anything, but you sell the shares. The shares come to you from the brokerage if they're available. They have to be available. And the stock price will go down, and you buy the shares back from the open market and you give those shares back to your brokerage. Again, all that happens behind the scenes. All you need to do is hit the sell button at 74 cents with however many shares you want, and your brokerage will essentially let you know. Questrade usually tells you there's a risk review, and it does a quick risk review, and that's essentially them looking for shares to give you. So they lend you the shares, they come down, you give the shares, you buy the shares back, and you keep the difference between 74 cents and 46 cents. So that's the basics of shorting, and that is playing the downside. So if you're bullish, you play the upside, and if you can short, you play the downside, and you can make money both ways. Risks that you run into is that if a stock price continues to climb, so let's say it didn't go down to 46 cents, and this stock decided to go back up to 92 cents and continue on, you would owe the brokerage money. Right? Because you short sold at 74 cents and now you're at $1, you would owe the difference per share between $1 and 74 cents. I covered moving averages already, Lewis. So you can just watch the video and go back. And I covered a few things in there about overextension off the moving averages and what to look for. So. Yeah, exactly. Jordan answered that pretty good about the shorting. Anything else? Holy, we're almost at 2 hours. So I think I'll wrap it up. Unless you guys have some questions that I haven't really answered, I might just close down my live stream and leave. There's John to the rescue. I might close down my live stream just because I got my family coming back, and we'll leave the chat open. And if you guys have any live questions, John's here now. Tons of knowledge. I'm actually learning so much from John about the platforms and about fundamentals and technicals. He's also, I consider him a mentor to myself, and I hope you guys do too when he gives input to shares and trading. Obviously, always remember, you're in control of the button. You're in control of buy and sell. Never take anybody else's advice. Whatever I say is not a buy recommendation. It's just either suggestions on what I look for or what I'm going to do, or what I've seen in the market or seen in the past or looking for the future. So I'm going to close it out for the live stream and the video, guys, and we'll keep the live chat open and go from there. Just wanted to thank you guys so much for tuning in and taking part in this live webinar, and looking forward to putting together kind of a curriculum and hopefully running this thing once every 2 weeks for the next couple months, and we can all learn together. I'll keep putting in information. A lot of stuff I'm learning from the chart guys will feed through to you guys, and we can go from there and hopefully become better traders day by day and week by week. All right, guys, that's it. Kids are home now. Hello, family.